My name is Paul Mitchell. I'm a professor of agriculture and applied economics at the University of Wisconsin in Madison. And today in this video, I'm going to talk about the farm balance sheet as part of a recorded lecture for my class AAE 320. The learning goals for this section are to first off just learn how to create or develop a balance sheet and read one. It's sort of a life skill from in some people's perspectives to be able to read a balance sheet. We're going to focus in on farm operations. And then the next learning goal will be to differentiate or understand the difference, I should say, between a market basis and a cost basis balance sheet for asset valuations, and when to use which one and how. First off, just how they work, and then we'll get to when to use each type. Then next, we'll focus heavily on depreciation for the rest of the this lecture series. The two main types are straight line and declining balance. To use these to depreciate assets, to understand the mathematics, the formulas, if you will, how to do each kind of depreciation. And then we'll move into some very specific ones for tax purposes, how to use the depreciation tables and tax supporting documents for farms with the farm focus. And then Section 179 depreciation, which is commonly used in agriculture. And then talk briefly about depreciation recapture in Form 4797. So first off, what is a balance sheet? It's essentially a listing of everything that's owned by the business or the farm and everything that's owed to somebody else, all systematically laid out in a structured format so you can help understand it. And what it does is it gives you a statement of owner equity or net worth at a point in time on a specific date. It's typically at the end of an accounting period, such as the end of a year for tax purposes or whenever your farm's fiscal year ends. But sometimes they're done in the middle as well for interim, in the middle of the year for getting a new loan, particularly for buying a piece of equipment or land or something like that. So sometimes the bank will sit down and will develop a balance sheet for that purposes. And it's called a balance sheet because everything must balance. You got on the one side, you capture all of your assets, on the other side, all your liabilities, and then a basic accounting identity must hold. The assets has to equal the liabilities plus your equity. So if you can see all the assets, you can calculate all the liabilities. The gap between those two must be your owner equity or your owner net worth. And that's how you make it balance, is by changing the equity. So it's the equity is what's left over, the residual. So the big uses of a balance sheet are to measure two things: solvency and liquidity. Solvency is essentially a measure of the health of the firm in a financial perspective. Often people call it the financial ratios, the most common one being debt to asset ratio, but there's other ones. And it's just to get a sense of how much the business you own relative to all the other external equity providers. The other one is liquidity, which is your ability to generate cash to meet short-term obligations or take advantage of short-term opportunities that suddenly become available. And you don't want to have to disrupt the normal course of business. And so it's really the ability to generate cash in the short term. So here's a very simple structure. I've created very simple numbers just to illustrate the concept. Traditionally, we put assets on the left, liabilities on the right, current assets and non-current assets, current liabilities, non-current liabilities, equity to make the whole thing balance. And so you look at all the assets you have. In this simple case, you got 100 and 150, so $250 worth of assets split into these two types. And then you have these liabilities of $150 worth of liabilities. And the total assets has to equal total liabilities plus equity. So the equity balances the balance sheet out by being 100. But and so that like I said, this is very simplistic, but it illustrates the concept very clearly. So what is an asset that we put on the left side? Anything the firm owns that has value, because you can sell it or use it to produce other things, sellable goods. Again, you split them into liquid and illiquid ones. Liquid ones are easy to sell. They're ready for market. There's a ready market for them. There's grain, feeder, livestock are good examples. You can pretty much sell some corn or soybeans or large feeder fed cattle almost any day of the year somewhere here, within a nearby market for an area like Wisconsin. And then you have harder to sell assets. They don't move as quickly. The market is thinner. The movement is bigger. It's things like a big machine, a large combine that's only 5 years old. You can't sell that quickly on average, or typically. It takes time to find a buyer to get a fair price. Same with land and breeding livestock, things like that. And we usually split those in, like we saw in that sample, into current and non-current. The current assets are the ones that are a little more liquid and move quickly. The non-current assets are everything else that is a little slower, thinner market to turn them into cash. So current assets are things like cash, bank accounts, marketable funds, accounts receivable that people owe you. Inventories on their things like for these liquid assets like the grain, the feed, the supplies, and feeder livestock. Those are called current assets because you can quickly turn them into cash usually. Non-current assets is everything else. You got machinery, equipment, breeding, livestock, buildings, land, things like that. There's also two types of liabilities we saw, the current and non-current, and it's very similar to that. The current ones are ones that are due soon. The non-current are the long-term obligations or debts that you owe. So current liabilities that usually what we use are the 1 year level. So things due within a year. So these are accounts at supply stores, feed stores, gas store, LP gas, interest and principal that's owed on the operating and long-term loans that are due, within the next year, and then accrued expenses like property taxes or income taxes. A lot of farms pay quarterly taxes, and then they figured out at in the April taxes when the final taxes are due, sorted out. And you can estimate your taxes. And so if you're doing it for the next year, even if it's, July, you're going to owe taxes within the next calendar year before, the next year for the year you're currently in. You can estimate those accrued taxes. Non-current liabilities is everything else, anything that's due longer than a year from now. So it's the long-term balance due on your long-term loans is usually what we think of there after you deduct your current year's payments. That's primarily your non-current liabilities. So here's an example of a balance sheet. This is from the Oklahoma State University. The web link there is at the bottom. It's got a pretty traditional structure. It's got the name of the business in the top left. It's got a date. It should be 8/21/2020. It's up in the top left here. Is this also what kind of a balance sheet is it? Is it for the farm business only, or consolidated for both the farm and the personal assets, or just the personal assets? A lot of farms, particularly if they're smaller, kind of mix the personal and business assets, and so either you lay that out together, or other ones have to keep them separate for strong purposes. Maybe you're in a partnership or an LLC, and you have to keep your business assets separate from your personal assets. This example here is actually a consolidated one. There's some personal assets in it. And then you have the beginning and ending period here. This is the middle of the period, 8/20, August. But they have a March 1st, 2019, and then February 29th of 2020. So there's a calendar year there, and it has the asset value on the first date, and then the asset value on the second date, and then it calculates the net change. But what you see quickly is it's split in that traditional format. Current assets, non-current assets, total assets. Current liabilities, non-current liabilities, equity, and then total liability and equity. And you notice it balances. The column A at the bottom here sums up to what the column D is. All the liabilities with equity adds up to the same exact number. But it's very much that structure. And you can see the kinds of things that are on here. The cash and checking, inventories of animals, marketable livestock, stored crops and feed, et cetera, supplies, things like that. And then here's their non-farm assets, the personal assets. They have a savings. And so they add them all up. You get your $336,000 of current assets. And then they go through the non-current assets as well. They got machinery, buildings and land, vehicles, stuff like that. And very commonly, we'll see some other examples. You can just do it this way in broad categories, but very commonly, you will have a schedule attached. Vehicles, it says $133,908 on March 1st. Well, what vehicles are those? You can have a task schedule that says, okay, that's this truck, this machine, this car. That's your assets in the vehicles, and they have specific values for each one of them. That's a very common having attached schedules, and this is the summary sheet, if you will. The same thing on the liability side. There's a lot of current liabilities that are due within the year, and then you have the non-current ones that are the long-term payments due on various things. The last one is equity, and it kind of shows you here, where does that equity come from? You got contributed capital, that's from somewhere else. It could be as simple as maybe you made an inheritance of $93,500. You put that into the farm, use it to pay down debts or buy things for the farm. Retained earnings, that's money you made in years past that instead of removing from the farm and using for personal purposes, you kept it within the farm. So let's say the farm had a good year, made $200,000 of profits. You take $100,000 and pay yourself as a farmer, for your living expenses as the manager and owner. And then the other $100,000 is kept within the farm. that's a retained earnings. You use that money to, pay down debts, buy some more livestock, put down as a down payment on some more land, things like that. That's retained earnings. And then the valuation equity, we'll get to that. That's going to be, the value of the land or some of those things. But it's the source of some of your equity is the value of the assets. And then last thing here, it all adds up again. You notice that $3.228 million is on both sides. So the business is fairly large at $3.228 million. And this couple, James and Dolly Madison, own, $2.3 million of that money. So they have a pretty large operation here. So that's an example. So there's the other one that's pretty traditional, but in agriculture, there are parts of the country and types of organizations, certain banks or lending institutions that use alternative forms. And really what they do is they take the non-current assets and split them into intermediate and fixed or long-term assets. And this was fairly common years ago, and it's still common in some areas of the country. So these intermediate assets are the less liquid ones. The traditional amount is 1 to 10 years. And this is where things like machinery and equipment, perennial crops, like maybe an orchard would fall in, or breeding livestock. And then you have fixed assets that are over 10 years. And this is things like the land and the buildings. And same on the liability side. 1 to 10 year loans are in the intermediate liability, and the long term are in the more than 10 years. So here's an example from FinPac. This is done out of the University of Minnesota. This is an example from 2017. Well, this date is, so it's after 2017. But it's just an example for illustrative purposes. Slim Jim sample. It's obviously an example. And there are plenty of people in that part of the state of Wisconsin, the western part, that, Minnesota, Minneapolis, St. Paul, University of Minnesota is our closest land grant. UW River Falls is up there. And so people definitely see this in that part of the state. And you see it's that structure. I laid out current assets, intermediate assets, long-term assets, current liabilities, intermediate liabilities, and long-term liabilities. And then they have the statement of equity or net worth in here as well. So you can see, even though these are both, university-affiliated organizations, they still have very different structures. And you'll see the whole layout. This one has the schedules. If you wanted to go look at them, it says, we'll take a look at, breeding machinery, Schedule J. You got titled vehicle, Schedule K. You could actually see where this $81,945 worth of titled vehicles, how it's embodied, and you can go to any level of detail you want for your balance sheet. You could have a very discrete or very laid out value for each item on your list, or you can just be very general, like we saw the Oklahoma State Oklahoma State balance sheet. So this one's all laid out, and you get a sense. And they also do their they have a statement of net worth. They have the total farm assets, total farm liabilities, and then they have the total assets here. And then they have the equity to make it balance over here. And so you can see this operation has an equity of $2.6 million. But the business itself is worth about $4 million. So the last section, the thing I really want to make in this last point is to talk about equity. We touched on it there, but I really want to focus in on equity and what makes equity change. It's essentially the part of the business you own. If you think of it from a company perspective, there's a company that's worth, the previous example, $4 million. You don't own all of the company or all the stock, if you will. You only own a part of it. The rest is owed to other people. If you had to cash out and sell everything and sell the operation, you would keep the equity part, and other parts would be given to the external equity providers, the lenders or whoever else gave you money that also owns part of that business. So this is the part of the business you own, and what changes that? The equity, the net worth. Profits or losses from production activities that you retain within the business. If you sell the assets for different values than on the sheet, maybe you put a tractor on there that's worth $30,000, and when you cash it out and decide to sell it, it's like, oh, it's actually worth $35,000 that we got. Okay, great. That's why your equity would change. You sell it for a different value than on the sheet. The other way to increase or change your equity is to bring in new capital into or out of the farm, your capital. Like maybe, like I said, you get an inheritance, and then what you do is you invest that into the business, and that would increase your ownership of the business. Your equity would increase. You get $100,000 inheritance. What you could do is take $100,000 and invest it in the farm. Your farm goes from a $4 million to $4.1 million business, and you take that $100,000 and do something like buy some more land, or a down payment on some land, or improve your buildings or something like that. That's it's an inflow of capital, of your capital from some other part of your personal assets. Or and same thing, you withdraw it as well. You might take the money out to do something with it, like send your child to college or something. The last one is if you market prices change, and you don't sell the asset like you do in the second bullet point, but you know the market value of that asset changes. Like land is, for example, you see your land value is increasing. That can increase your equity in the business because the business owns these assets and they change, they go up in value, and your liabilities don't change, but your assets go up in value. Therefore, you have more equity. The last thing, like I said, part of this is I really want people to understand equity and what changes equity. So business transactions really only change the mix of assets and liabilities, not the equity. What you do when you have a business transaction, you shift the liabilities and assets around, but you don't change the equity part down here at the bottom. That stays the same. So like, let's say you buy a $10,000 piece of equipment. I don't know, a disc or a plow or something like that. If you bought it with cash, you would drop your current assets would go down $10,000 because you removed $10,000 of cash, and you just converted it into a non-current asset, a piece of machinery. So that would go up $10,000. Instead of taking your cash, you borrowed the money. Your liability would increase by $10,000, and your non-current assets would go up by $10,000. And so you're moving it around in there. But your equity won't change. Your equity only changes due to business profits and losses. You put money in or pull it out, and then if asset values change or you sell it and figure out your asset values were wrong, like we did here on these 4 reasons right here at the bottom of the slide. So here's the part where we do a think break. And if you want, you can pause and work through these examples. And you have 2 points to do. First off is just fill in the empty entries on the balance sheet. It has to balance, so you've got 2 question marks there. Fill those in. The second part would then be, how would this change if you bought $100,000 of land by taking $40,000 from your savings and borrowing $60,000 from a bank? How would that change these numbers on this balance sheet? So take a pause to answer both those questions, and I'll go through the answers. So the first one is pretty straightforward. How to do make the balance sheet balance. I just put the numbers in red, but $400,000, $1 million of total assets. You have $400,000 in current. Well, this has to be $600,000 because this column has to add up to $1 million. Same thing over here. The column has to add up to $1 million because these both halves the balance sheet balance. So you've got $1 million or $500,000, $150,000 plus $350,000 is $500,000 of liabilities. Well, then the equity has to be $500,000 so that the whole column adds up to $1 million. So that's pretty straightforward. Now let's look at that $40,000 purchase. You spend $100,000 purchase. You bought $100,000 worth of land. Let's say it's a down payment on the land. You take $40,000 of your current assets. That's where the $100,000 partially came from. Well, if you go back, this was $400,000, and now it's going to go down to $360,000. That's because you converted some of your current assets into a non-current asset. Non-current assets go up $100,000. You have $600,000 non-current assets. You bought $100,000 worth of land. That's got to go up $100,000. And then where does the $60,000 show up? You brought $40,000 from your current assets. The other $60,000 has to come out of into increasing your liability somewhere. In this case here, I added it to the $350,000. I considered it a non-current liability. Realistically, some of it would be due within the first year, and some would be due, later. But the idea, what you'll want you to see here is 2 things. One, you move the mix around of assets and liabilities. The business became larger by $60,000. So it's instead of $1 million, it's now $1,060,000. So the business is larger, but your equity stayed exactly at $500,000. There was no change. All you've done is rearrange things. Hopefully, you've done it in a way that's more productive and has a return on that investment, and so you can generate more income and greater retained earnings in future years and increase your overall equity. But this actual activity itself did not change your owner equity, only the mix of how it's embodied in assets and liabilities.